So today's lesson is going to be level 3 time frame analysis, time frame forecasting, and the speed of money flow. So this lesson is really going to get you to think about it's going to kind of go back to what we talked about in the prior lesson about round trip speed, but it's going to explain a little bit more about why the speed is the way it is on the institutional level. And that way you can kind of visualize what's happening behind the scenes and just kind of build upon that. But this lesson should be actually relatively short. There's not a whole heck of a lot of slides here, but it's a good concept to understand what's going on behind the scenes. So let's get straight into it. So we're going to talk about speed of transaction. So right here we have institutional investment banks and market makers, which are the people that move price. They're the ones that are able to move the money around, the significant amount of money that actually makes price changes. So they have two different things that they're doing. They're doing proprietary trading, and they're also doing algorithmic market making. So as we go through here, in proprietary trading, for large transactions, phones are still used to record and verify conversations, reducing their speed. Going back to the whole round trip speed, meaning getting in the market, getting out of the market, the way that they build positions over time, and this is all for proprietary trading. When you're trading the size that they do, you'll still see on Wall Street, they still are picking up the phone to place the trade, typically with an interbank broker, So that needs to be documented. It needs to be recorded. And they record all these things because of the large risk that is associated with making these trades. This is not a $100 pip. These are $1 million pips. These are big trades. So the fact that they need to pick up the phone and get these positions opened, get them filled, creates even more lag time. So what you could think about is are they really doing this on a minute by minute basis? Sometimes if it's really hectic, but this kind of goes in the whole idea that the market makers for their proprietary trading side of their business are taking time to build positions. And this is just one reason for that, the added time. It's not the matter of just simply clicking the button. It's a matter of documenting the process and having proof of what was said, what the commitment was, and that agreement. It's just recorded, and everyone understands that that's involved in this process. Whereas algorithmic market making is done for smaller transactions and just general matching, which is also side of their business. When we pay a spread, this is for that service. This is all that matching that needs to happen behind the scenes. So smaller transactions from brokers are sent to algorithmic market making servers for instant matching. This used to be done manually. There used to be people hired for this job years ago, but with computers getting faster, better, so on and so forth over the years, this literally goes to a server room in the bank, and it just happens automatically. And there are guys, market makers, that are assigned to just watch these things and make sure they don't break. But the machine is doing it. So most of the business, as far as transactional volume, all these little transactions happening, can be pushed to this system. But these systems still need to be watched. And this is where you get all these minor fluctuations on the 1 minute and the tick charts is going to be reflective of all the little positions being digested on these algorithmic market making servers. Again, then these are all it's just ran by an algorithm that is designed to match as efficiently as possible. But those algorithms can be tuned to bring positions in-house for the bank for proprietary trading. They still are ran, but there's just so much volume that no one person can process that manually. It's never going to happen. So there has to be an automated way to handle the flow of business and make sure every traders, even on the retail level, are all looking for speed. And the reason why you get such speedy fills and the reason why electronic trading can exist in the way that it does today is because these things exist. Otherwise, we would all still be getting on the phone and placing a trade. So that's, this is definitely an advancement in speed, in making trading very convenient, but it has changed the game a little bit. So that's what I want you to get from this slide, is that when we're really looking to, we want to understand that there's algorithmic market making, but we're really looking to follow the bank's footprint on the higher time frames. And the higher time frames, because of the nature of how that business is done, makes it slower to get in, slower to get out. And the fact they got to still pick up the phone for documenting the actual process, recording the conversation, and that way if anything doesn't go right, they can reference that conversation, what was said, how much did the trader want to trade, what was the commitment. They can look at that and see what actually happened. And it does slow down their process. But these guys are not interested in trading a 1-minute chart. These guys are looking for daily, weekly, monthly moves, scaling into positions and scaling out. And when you're looking on that time frame, you can pick up the phone and place a trade as you're building into your positions and scaling out of them. All right, so we're going to revisit again the scale of time frame influence. The speed of the round trip trade is dependent on the time frame of the strategy, even on the institutional level. So starting at the tick, going up to the monthly chart, we see that we have market making volume. So those fast transactions that are automatically matched up, those are going to be on the left side. So the lower the time frame you go down to that you're viewing, the more market making activity you're going to have on those. That's all going to be automated, algorithms handling most of it. Whereas the higher time frames you go up to, you're going to be more into the proprietary position trading volume that's happening in the market. And so we have on the left, small, fast money. And then on the right, we have big, slow money. But the big, slow money is the stabilizing money. That's the reason why you see a weekly chart stack week after week after week after week, continuing in a trend, is that's the effect of big, slow money. And that's why it's so important when we talk about trading the ATS methodology, is that we're always grounded in the directional bias. And it's not that we're just saying like the trend is your friend. There is a reason for that. A very important reason is because we're following the bank's footprint, the big, slow money. It's so that we can participate in their success and follow their strategy. So, but this is a reason why that is, why it's happening. And it's a reason that you should take away from this is that that you want to follow that big, slow money, because that'll stabilize your trading. That's what's going to allow you to have probability in your favor. And that's going to be very good for you. So, all right. So higher time frame activation. This is another concept that we're going to talk about, because this is really about understanding the higher time frames and the dynamics that's going on in those higher time frames. So right here we have an example with the 1 hour time frame. So you see we have a contraction period that's happened here and a breakout from that contraction period. So if we look at the text there, it says 46 period activation, which is equal to 1.91 days. So what that means is that as we broke out through that high, it has been 46 periods of this 1 hour candle since that high. What that does is that when we come through that high is going to be significant for people that are trading on a multi-day basis, 1 to 2 days. They're going to be looking at that high simply because of the time it's taken to get back to that high. Okay? So that is going to activate people that are on a 2-day outlook to come in and make decisions about the market. As we come back down, we notice with this one, we have a 67 period activation, which is also equal to 2.79 days. So in the first one, we have 2 days. 2 days, people that have a 2-day time frame are getting activated. I'm going to either buy, I'm going to sell, I'm going to do something. They're transacting. Now people that are getting closer to 3 days are getting called into the market, simply because the time from that low to the time we have the spike down is almost equal to 3 days. As we go, continuing this expansion phase. Now we have a 95 period activation, which is equivalent to about 3.95 days, 4 days. Notice how the days, we have a multi-leg expansion happening here. But notice as this is happening, the days are getting longer and longer and longer. And what do we talk about with expansion? We talk about the more expansion legs we get, usually it represents that there's some indecision on the higher time frames. But we will continue to expand to make swing high, swing low points until we get a high enough time frame to activate to move it into the trend phase. So you can see this, and you could go check this on your charts and look at this for yourself. But as we are moving through these highs, we are activating higher and higher time frames because of the time between the previous low or previous high point is getting wider and wider. As we go down, now we have a 162 period activation, which is almost, now we're at 6.75 days, almost a week now. So that spike down has woken up the weekly people. We're getting into the whales here with this activation. So if you come through one of these lows that you see from way back when, it might range out a little bit there sometimes, but just know if you count back how many periods or how long it's been, you can see who you're waking up. So if you come through a low, in this case, that's almost a week from a week ago, you can go look at the weekly chart and see what that coordinates with, see where you are in the cycle on the weekly, and see what are the potentialities from this price level. In this case, this is a support level. What could happen on the weekly? If the weekly holds below the support level and breaks out, how far to the next support level on the weekly chart? Because the point is, you're activating the weekly trader, the person that is taking the swings on these weeks. They're getting, and you know they're getting woken up because a price point that is important to them. What would this be equivalent to? If this is weekly, this would be last week's low. We are now looking at a weekly candle that's here and the current weekly candle coming through the low point of last week. These traders are thinking like, are we going to break out short? And looking at the weekly. And what happens if they're trading on the weekly? Now we're getting into big, slow money. What are they going to do? If they buy or sell here, what are they likely going to do? They're going to hold that decision for probably at least a week to 2 weeks. So whatever happens here at this point is going to create a stabilizing effect, whatever the decision is in mass, for the next week to 2 weeks, 3 weeks, maybe 4 weeks. So that's an important point, is that when you are waking up higher time frames through monitoring the multi-leg expansion, you know that the reaction from those time frames, from that origination point of that low, however far back it was, is going to create a mind shift that's going to create transactions that are not going to be unwound for probably that period of time, or that at least one period. So anyway, they're getting into the weeds here, but it's important to understand that the whole speed of transaction, speed of money flow is dependent on waking up these higher time frames and activating them. And we can see that in the multi-leg expansion. And so when you have something that is 6 or like, let's say 3 to 5 expansion legs have been confirmed, you need to ask yourself, who's getting woken up here? This is a way to, and this is an advanced concept, but this is a way that you can dynamically change your directional bias. Very advanced, wouldn't recommend it to new people. I suggest you always just stick with the directional bias. But in reality, if you know who's getting woken up based off of what we're looking at here, is there any reason why you can't go jump and look at a daily and weekly chart as you came through this low? Because you know that's who's getting woken up. That's where the decisions are being made. So I want to be looking at what they're looking at. You still look at the lower time frame for your entries and everything, but this is a way to dynamically change your directional bias based off of who's been recently activated on the higher time frames. So again, advanced concept, that you could easily, if you're not ready for that, that could not be a good thing. It's usually better just to stick to your time frames don't move it. But that is reality. That is what's happening here. All right, as we go up, now we have a 120 period activation, 5 days. So now it's getting smaller. So we're starting to go in the distribution, but now it's already picked its direction, and notice that the time frame, the activation is now shrinking. So, that's what it's going to do. The market's going to activate higher time frames, then it's going to shrink to smaller activations as it picks its direction and goes through the 3 market phases. Okay, so another example here. So this is higher time frame and symmetry and fulfillment. This is another advanced concept. This is something that you should be aware of, but you shouldn't get too far into the weeds. Another thing I said on a previous lesson is that I'm sharing things in level 3 with you that are very interesting for the inquisitive mind. You're going to find this very interesting, but don't let this distract you from the basics of the master pattern, which is directional bias, trading overvalued, undervalued entry, keeping your lot sizes small so that you can have time in the market, let these things come around and pay you. So don't get distracted and back test this stuff and get crazy with it for the next year. It's good to know sometimes these things can give you a little bit of an added edge in given situations, but you need to make sure that they're not clouding simplicity. Simple machines are what keeps things running, not complexity. So make sure you don't let this detract from the simplicity of the method. Okay, so liquidity is harvested from 93 periods ago. We see 93 periods divided by 24 hours, which is 3.87 days. So in this situation, what timeframes are being activated? We have a 1 hour, a 4 hour, and a daily time frame are all in play at this point. So we're not quite at a week because it's 3.87 days, but we could basically look at the day for sure is being activated and everything below it at this high, down to the 1 minute tick chart. They're going crazy at this high. So we could look all the way up to the daily to understand what is this reaction going to do. So we look at our daily chart over here. We can see that in this situation, this is the 1 hour chart on the left, but what happened on the daily on the top right there, we can see the daily spiked up through that previous day's high, and there wasn't any follow through on that. Okay, so we get that clue over there. We're also in an expansion based off fair market value. Where's fair market value? It's based on the last little blue box right there. So we're trading in around that equilibrium. Okay, so what happens here? Okay, from the confirmed swing low point to where we took out that liquidity, we have 46 periods since that cycle low. So what you're going to see right here is you're going to see symmetry play out in the market. So if this has happened, we look at the confirmed swing low point on the current expansion to where we came through this high point. We have exactly 46 periods. We're looking for it to take, if it's going to come to the swing low point, that it's going to take somewhere around that amount of time to get back to the swing low point. If it's a multi-leg expansion. Now it may just break out still from here. Obviously we can see it didn't because we're looking at the daily chart up there. But you can count on to some degree that there's symmetry based off what we've been talking about. That we're gonna, if the expansion is gonna keep growing, it's gonna continue to take longer and longer and longer to get to the swing high point. So we could expect, if you're trying, let's say you're going to short right here, like I sold right here based off of that, I feel like the daily, the weekly at this point is all going down short. How long should I expect it's going to take from this X right here on the chart coming through that high point to get to the swing low point? How long relatively should I budget for time-wise? That's where we look at symmetry. 46 periods since the last swing low to this point. So as we go down through here, you can see that we get a major move through the cycle low, which was exactly 48 periods later. So we would expect that it's going to take 46 or above periods. Why is that? Because the nature of multi-leg expansions is higher time frame activation. And so this is activating a higher time frame on the swing low point. And that gives us a time frame that we can look for fulfillment of trading ideas based off of shorting off this high point right here. So everyone with me on that? I know this is like pretty in the weeds here, but yeah. Hopefully I'm not losing you guys on this one. So, all right. So that is symmetry and fulfillment. So again, this lesson wasn't going to be super long. Quickly, what's the takeaway? The speed of money flow is what creates trend stability. If you want to forecast the future of the market, you need to figure out what timeframes have been recently activated from the market maker's perspective. Use those timeframes to analyze what price is doing and where it's likely to go. Look for symmetry in the market to help you come up with realistic expectations on how long certain opportunities may take to play out, which was our last example that we just went through. So again, I don't want you to get lost in this, especially if you're watching these videos and you're new to this methodology. You just need something you need to be aware of. There's a lot happening in the background here. There's reasons why we teach what we teach. You don't need to know everything I taught you in this lesson to do well with the method, but you do. It is good to know that how you're trading the master pattern methodology is in line with how the banks do their business. It's in line with those sound principles. And so this is just opening your eyes to the real mechanics that are happening behind the scenes and why it's good to follow best practices to make sure you're on the right side of the market. So do you guys have any questions on this one?
Hi, Wade. Thanks very much for that lesson.
Yep.
Is there a rule of thumb that we could use for the time frame that we're using with our entry time frame to count? So, for example, like how many days would it be with the daily time frame, or how many periods would it be with the hourly time frame? Just sort of get an idea in our mind, or how many periods it would be with the 5-minute. Do you follow what I'm asking?
Yeah, it really, like the if you're looking at higher time frame activation, you would look on your whatever you're using for your entry time frame. So let's say that it is a 15-minute chart, right? And let's say that you came through a high or a low, very predominant. This is not, we don't need to like overcomplicate. It's like you see a point, right? And we're coming up through that point in the past. How many periods measured back to that point to where you revisit it? And so if it was like, let's say it was, we'll do the math. Let's say that you just came through a high on your 15-minute, and let's say it was like 65 periods back. So we have 65. We could turn that into hours. So we'll divide that by 4. So that would be 16 hours, basically, right? So, but there's not really like a 16-hour chart. So we could divide that. What would be? You would look at that and say, what would be relevant to that on a higher time frame? So to me, 16 hours divided by 4 again, if we're thinking about a 4-hour chart, how would that correlate? So that would be, 4 4-hour periods. So the higher time frame activation on that, to me, based off of that, just dividing it into the higher time frames, starting with a 15-minute chart, I'd be looking at mostly a 4-hour chart. Would be the most relevant common time frame, that you'd be looking at, and maybe up to a daily chart. Your daily's not quite been activated because it's only 16 hours worth of movement, but you're between a 4-hour and a daily. So I would look at those two time frames to figure out we know they're getting activated, especially the 4-hour. What decision is being made mostly for 4-hour traders based off of coming through this high that was, whatever the period, I forget what they were, but 60-some periods back on the 15-minute. So does that kind of make sense?
Yeah, it does. Yeah. Thanks very much.
Yeah, no problem. It's kind of a crazy, weird concept, but this is something that I started noticing this symmetry probably 5-6 years ago. And there's not, you can't really put like a perfect, you can't really put like a perfect rules-based methodology around it, but you can be aware that it is active in the background, and that's really all it's supposed to be. It's just supposed to be give you a situation where it is helping you potentially in some situations really get a better forecast on where you think price is headed. That's really it is. And sometimes it could be the difference of you holding in a few extra candles and seeing the fulfillment based off of the time symmetry. It just gives you a little extra edge sometimes. But again, you don't want to overcomplicate it. So, Joel, I see that you're there. Go for it.
Hello, Wade.
Hey, Joel.
Yeah. Okay, I was asking what do you qualify as a cycle? That is a trade cycle, because I saw you were explaining and then you talked of cycle made up of a strategy, something like that. I don't know if I got you well. And then I was thinking in my head, the way I qualify a cycle or speed of money flow can be from a contraction box to a fulfillment when the market gets to the order block from that contraction box. I don't know if I'm right.
So you say really what is the definition of a cycle?
Yes.
Yeah. Okay, so a full cycle definition is the 3 market phases, meaning we have a contraction, we have an expansion, and we have a trend. So that's the basic definition of a cycle. But there are also there are 3 components to those cycles, and sometimes we'll refer to them like the trend cycle. So if we are in the cycle of the trend, sometimes we'll say when the cycle's finished, and we're talking about that specific piece of the overall cycle. So it can get a little confusing as far as what we refer to sometimes. But the overall cycle, when I talk about it, mostly what I'm referring to is we have a contraction. That is the first phase of the cycle. Then when we leave that box, we go into expansion. That's the second phase of a cycle. And that can play out a number of ways. Usually we're looking for a multi-leg confirmation, meaning we take out the high, low of the box, or vice versa. Now we can clearly see we are in the expansion phase of that cycle. And then from there, we are going to into the trend phase. So we're definitely looking at those 3 different things to play out. And we talk about where are we in the cycle. And so we're trying to get a good read on which piece we're in. So anyway, that's what I talk about. Does that kind of answer your question?
Yes. I wanted to add to it that sometimes getting to the order block projection, it looks like that is the ultimate completion of a cycle. Because that's what I seem to be aiming for. Because I also use that same strategy for entry, because I also enter based on order blocks. So if I see that the trade has hit order block, I kind of wait for a new box to be formed, then to start a cycle again. So that's it's just a strategy that I've developed while studying the master pattern.
Yeah, so you're looking at like by the time you hit an order block projection, then you're basically looking at okay, I've likely had the trend phase happen. So you're aiming for those, and that's fine. Either way, by the time you hit a far order block projection on the current cycle, chances are you've gone through the trend phase usually, especially if it's a far one. So that's not a terrible strategy, but it's not always true. Sometimes we could hit order block projections and trade right off of them and go into another expansion leg, but it is a good practice if you are looking at trading the trend part of the cycle to just look at hitting a decently far off order block projection and taking profit, especially that's good enough, right? So yeah, I'm right there with you on that, and I think that's a good strategy.